The words stock market crash often cause panic among investors, but does every market decline always lead to losses? No. Instead of panicking in such situations, it's crucial to adopt the right approach. A market downturn doesn't always signify a loss. If handled smartly and with an effective strategy, this situation can turn into a significant opportunity. In this video, we'll share 7 effective strategies to help you navigate a stock market crash, safeguard your investments, and transform this situation to your advantage. When a market crash occurs, many investors panic and sell their stocks and mutual funds, fearing further market decline and potential losses. However, this is just a temporary phase. Just as markets fall, they also recover over time. If you're investing for the long term, there's no need to panic. Market fluctuations are normal. It's the nature of the market. Long-term investors always benefit in the end, so stay patient and avoid making hasty decisions. During a market crash, stock prices drop. This presents a golden opportunity for investors to buy high-quality stocks at lower prices. If you've already invested in a good company that appears promising in the long run, consider investing more during this time. If you're investing through a systematic investment plan, SIP, continue it. When the market is down, you get more units for the same amount, increasing your return potential. Lump sum investment can also be a good option, but it's better to implement it gradually to take advantage of market volatility. A market crash presents the best time to thoroughly review and rebalance your portfolio. Adjust your portfolio appropriately, considering your financial goals, investment value, and time horizon. If you've overinvested in any asset, it's essential to balance it. Overdependence on a single sector or asset type can be risky. Therefore, rebalance your portfolio regularly to reduce overall risk and potentially enhance returns. To shield yourself from the impact of a market crash, portfolio diversification is crucial. Your investments should be spread across multiple assets, such as mutual funds, stocks, gold, bonds, fixed deposits. If the value of one asset declines, others can balance it out. This way, your overall investment portfolio remains safe, and the overall risk is reduced. During a market crash, the most important thing is to control your emotions. Market ups and downs can trigger emotional responses, leading to hasty and ill-informed decisions. Such impulsive decisions often prove to be wrong, increasing your overall risk. So, carefully analyze your strategy and make informed decisions. Make investment decisions based on your risk tolerance. Sometimes, market volatility can present an opportunity to refine your strategy. Seeking advice from a financial expert can be beneficial. Having an emergency fund is crucial to handle unexpected situations during a market crash. This fund can provide immediate support during financial emergencies, allowing you to hold on to your long-term investments without losses. Additionally, maintaining some liquidity is essential for quick and easy access to funds when needed. Keep a close eye on market trends and global economic indicators as they can directly impact your investments. Utilize new financial tools and reports to understand the market better and keep your investment strategy effective and up to date. Simply investing isn't enough. Understanding tax implications and reinvestment strategies is crucial to maximize your returns. Regular financial planning helps you prepare for market fluctuations and make informed decisions at the right time, securing your investment goals. Fluctuations in the stock market are inevitable, but with a robust financial strategy and informed decisions, you can safeguard your investments and make them profitable.